Welcome back to Venture Wisdom, the place where we talk all things venture capital and private equity. I'm your host, Rakesh Bhatia, and today we have an interesting topic which just does not cover VC private equity alone, but has a good set of information for founders as much as it is for the VCs to help them make exits. And you already heard me, I said exits. So we are talking about strategic exits and acquisitions. With me, we have Shawn Flynn to have this chat and share his knowledge with us. Shawn is an investment banker with Global Capital Markets. He's a board member at Association of Corporate Growth, ACG Silicon Valley. He's a podcast host himself and a deal maker forever. So thank you, Shawn, for taking time and welcome to Venture Wisdom.
Rakesh, thanks for having me here. I'm really excited for today's conversation.
So, Shawn, you heard me, right? So we are talking about strategic exits and acquisitions. But then before we jump into the subject itself, I would love to hear more about what you do in your professional life and at the global capital markets.
Perfect. So I guess a lot of people have mysteries around what investment bankers do. So think of it this way. Here's my little analogy that I think really paints a picture. You go through life, you meet that special someone, you're walking hand in hand, and two equals become one, you get married. Well, that marriage, that's a merger. All right, now you're in the park with your significant other, and you see a little puppy, and you go, "Oh my gosh, this little puppy! If we bring it in our family, there's going to be so much more love." So that puppy, you acquire that puppy, bring it into your house through an acquisition. Now the family's so much bigger, there's so much more love, but you got to take the dog to the vet. It needs shots, it needs food to go from this little dog to this big dog. So it needs money, it needs growth capital. And then the dog has puppies of its own, and you decide, well, this one puppy would be better for the neighbor's kid or this person over here. So you sell off one puppy, it's a divestiture. So all these transactions that happen in life, I do those with businesses all day long. We focus on the middle markets. We're sector agnostic. Being here in Silicon Valley, I get the honor to work with companies at all stages, mostly tech, but I've just had the incredible opportunity to talk with founders such as yourself on a day-to-day basis where I'm sitting there going, "You're creating what? That's even possible? That's incredible." And then helping them with those transactions just mentioned, whether it's raising growth capital to get to the next round, whether it's, okay, we're in talks to get acquired, or maybe we want to go public, or maybe any of these types of transactions that naturally occur in the life cycle of a business, I get to step in. And ideally, I'm working with a company for 1, 2, 3, multiple transactions throughout their life. And I'm working with the founder or board or advisory team or whoever very early on to help prepare them for these types of transactions because they just don't happen the next day. There's a lot of planning that goes into them to make sure they're done right. And what I mean by done right is you're not leaving money on the table. You're not having those gotcha clauses in contracts that come back a year later to haunt you. You're not setting it up for failure for a year or two later, which people don't quite understand how an investment today can either destroy the cap table or put it in a position where a year from now, 2 years from now, those investors won't really be excited about the company because of the contracts, the things that were done earlier. So we work with companies very early on, normally a year or two before they want to do these transactions, all the way through the transactions. And I know we're going to talk about what these transactions are later because people think, oh, you sell a business, you just put it online and then next day you get an offer. When in reality, these are 6 to 9 month process. Oh, sorry. I've worked on deals that have been 13 months or more that it's crazy how long some of these deals happen. And it's not because people aren't moving. It's just because there's so many components to it. There's so many ups and downs. There's so many things that can change. Um, and I'm sure we'll go into all these. But yes, we work with companies throughout their life cycle for these transactions. And it's exciting. I love what I do because I get to meet and talk with the most interesting people in the world. I get to see what they're building. And I feel like I'm helping out the future a little bit by this. So I'm not sure where you want to take the conversation. There's so many ways, but I'm excited.
but that sets the right tone for our conversation. I'm glad that you brought that up. And while you mentioned that zero to finish line, it may take 6, 9, 13 months. In fact, initially, we would like to get into what is the minus one as well. How do you actually align yourself to the strategic exits or being or identifying a potential acquirer, assuming that we are talking from the sell side. But then before we get into it, a general high level overview of what a strategic exit really mean for founders and what kind of strategic exits do we talk about?
Great question. So you'll look at it as who's the buyer, right? If it's a private equity group or maybe a family office could be strategic, could be financial, depending on what else is in their portfolio. But private equity groups and that they'll look at things mostly from a financial lens. They'll go, okay, this company is doing this much in EBITDA, multiples for this sector, this EBITDA range will be this amount. So, and those multiples get higher the bigger the EBITDA. So, for example, maybe a company doing 2 million in EBITDA will get a 4 to 6 times multiple on that. Maybe a company doing 5 times EBITDA will get a 6 to 8 times multiple. Maybe a company doing 10 million EBITDA will get a 10 to 12 times. It gets higher. The multiple gets higher the bigger the EBITDA, right? Now, that's just from a financial lens. Most companies can kind of predict, okay, our financials look like this, so our valuation based on financial multiples would be this. And then you have the investor going, okay, based on how the deal's structured, your company will get the higher end or lower end. Now, move that to strategics. Strategics are companies that have this infrastructure built out where your company, what it does when it gets plugged into that infrastructure, can be no one knows the exact multiple, right? And that's why strategics are able to offer usually more than financial investors because financials are looking at multiple of their return. Okay, we need a 20% return or 20 to 30% over the next couple of years, and this is growing at this amount, and then we'll sell it here. Strategics go, you have this software system that if we bundle with our existing product, now we can sell it to all these existing customers that we already have, and we're instantly going to make $100 million more. So we'll give you this, even though you're only doing a little bit in sales. We know once your product, your solution, or whatever is put in our infrastructure that we've built out, within 1, 2, 3 years, we've modeled it where we're going to get this extraordinarily huge return. So we're able to give you a multiple on this, on your company, that everyone else thinks is absolutely insane or crazy or just doesn't make sense in an Excel model to anyone other than your company or your group because you have all that proprietary data on how this is going to go where the synergies are, where the matches are, what, after the incorporation of the tech, what's it going to look like. So you have that information and you're able to map it out and go, okay, because of what we feel or our logic here, we're able to not give that 4 times EBITDA. We're willing to give 20 to 30 times EBITDA or something like that, that everyone else just goes, wait, that doesn't make sense. But to you, it does. So think of that as kind of the strategic versus the financial.
Financial. So,
I mean, those
how
numbers
does a
don't.
founder really know which is the right route to exit for them?
Well, it depends. It depends a lot. I mean, there's a lot of founders that want to be acquired by that strategic, but there's not a strategic out there that wants to acquire them. Right? They might be a good business. Maybe their technology's old. Maybe um, their technology, there's just no demand for it from one of these strategics. Maybe they're already doing it themselves, or they just don't want to go in that direction. Whatever it is, there's a lot of situations where there's not that strategic buyer for the company, or maybe the strategic's not making offers that are any any better than any of the financial investors out there. And the financial investors see, wow, this has growth, this has sticky customers, it's in a sector that we're interested in, it's in a sector where we already have a platform or we want this company to be a platform, and then we'll acquire others to add it on, and then we'll get this valuation bump with all these acquisitions we make together with this company, and they might give a better deal. I mean,
So
it's
are you saying that it's more situation driven than the founder driven? Or can I actually, as a founder, say that I want to make one or the other type of acquisition as a route to exit and start working towards that?
well, both routes to exit involve making the company the best company it can be, right? Making it with the best margins, making it with the best processes, making it with the best systems in place. And then the acquirers will come to you, whether it's the strategic, whether it's financials. I mean, how many companies out there, once they reach their Series A, are getting these emails in their inbox? We know acquirers for you, or we're this group, or we're that group, and let's sit down and have a meeting where we're interested in companies in your space. And the goal of the founders should be, how do I create the best business possible? And then when it's time to go out to market, shop it with strategics, shop it with financial investors, shop it with, do kind of a broad outreach. But ideally, also in that time before you're going out to market, you've built a lot of relationships. You have partnerships with these potential strategics. You have, met the M&A team of these strategics and financial investors in your space at trade conferences, or who knows, maybe you flew into New York or Chicago or San Francisco to sit down with them for coffee, or you've built these relationships a year, 2 years in advance of when you want to make one of these major transactions, and you start getting kind of the feel of, okay, this person, their appetite for my company is this group, their appetite is over here. Where do myself and my investors, where do we kind of want to exit, right? If you're thinking, okay, I want, say, on my exit, I want 10 million in cash in my bank, and I own 10% of the company. We have to sell for 100 million. Okay, what do we need to get to so I can get that exit, so I can get the money I want, that my wealth advisor told me, my tax strategist told me, and all these people told me I'll need to live the life I want, to go on. And so I start planning that in advance, way in advance. This is the outcome I want. All right, so the company needs to be around this size, so it gets these multiples, or this strategic will offer this amount, and then we can facilitate the transaction. Right, that's a well planned out transaction. What normally happens is nothing like that. What normally happens is there's a disruption in the market and they have to move fast. They're not able to raise their next round. They have to move fast. They are in talks with for some type of partnership or to raise capital, and that entity says, you know what, we'd rather just acquire you. Here's an LOI. There could be a death in the family. There could be illness, sickness, a divorce. There could be infinite number of reasons where this transaction that you'd want to think out many years in advance has to happen rather quickly, and then you're just going to market with what the business is at that time. And hopefully you make some adjustments, clean things up so you can get as good evaluation as possible. This is what normally happens. But ideally it's, let's run this business always like we're going to sell it tomorrow. And that way you're running it properly. You're having the conversations with the vendors and getting the contracts. You're talking to your bank and the finance. You're talking to your employees and getting everything documented and signed. You're talking to, you have your data room, which is a location where you're putting all the information on your company and updating it routinely. You're doing that. You're checking the metrics of your company. Hey, what's our LTV to CAC ratio? What I mean, that's one thing that is very interesting. Every industry kind of has metrics that the investors or acquirers track, whether it's growth, LTV to CAC, whether it's, this or that. If you're a founder, why aren't you tracking those metrics from the very beginning and kind of seeing where are we with what the industry wants, and how come we're not better than what the industry wants? because that'll put you in such a good position when you're talking to investors, you're talking to buyers. You show this history of data that you've been collecting, that you've been tracking throughout the years, and just go, listen, we're in this trajectory. These are the changes we've made. This gives a lot of confidence in your pro forma. This is where we're going because they're able to backdate it and check from before. You're able to do all these things if you're consistently collecting data and archiving it and reviewing it, and that data is what people are also wanting to see. I mean, there's people out there that track way too much. There's people out there that track nothing, and there's others that track. Hey, these are the key ones, the metrics. These are the ones we're tracking, and those are the ones you're like, okay, they're doing good. They're getting ready for this. But going back to what was said earlier, if you're always preparing for that exit the next day, basically that just means you're running the business efficiently, properly, and in the best sense, because also you're making it so you can step back at any time. And when you're the leader able to step back, that means you're also able to grow other areas. You're able to think bigger picture. You're able to implement instead of being the bottleneck. And that bottleneck is where a lot of companies have issues because of that one person won't allow others to get their hands dirty, so the company can't grow, it can't expand. But if you're running the business for an exit, you're stepping back, you're putting the right people, the right processes in place, in the idea that, okay, I'm not going to be here tomorrow, this is running without me. But in that process, you're creating everything to run so it can get bigger than it currently is, so it can
But
be more
that you make
efficient.
a very interesting point here, Sean. And well, the statistics, if you look at them, it says that most of the exits are always, or most of the exit are acquisitions, right? There are only three ways: you go IPO, you run it as a private company forever, or you exit through an acquisition.
Well,
But
don't forget the exit of closing the doors. That's a pretty popular exit too.
true, true, I agree. But yeah, so but you, as I said, you make an interesting point here, right? Running the business as you're going to sell it tomorrow. But if you see in practice, most of the founders are not founders forever. They are first time founders, right? And attaining that maturity of having that kind of readiness early on is generally not seen as prominently. It takes a while before you get to that point of time. And there are times when founders do get those kind of inbound offers when they don't even know what to do with those offers, right? So preparedness with that maturity is good, and it sounds good, but how do really how much do you see that happening? Question one, and how do you really get to that kind of maturity as a founder, because you are so busy acquiring more customers and building what you are building, and never even thinking of that kind of housekeeping processes, or the data room in place, or some of the compliances, things that can be overlooked are generally overlooked. So
No,
what's
I
your
think you're
thought about it?
I think you're spot on. It's very rare that you meet founders that are business owners that are like that. But also, it's very rare to meet founders or business owners that can continually grow their business. And what I mean by that is a lot of founders, they're able to get to that maybe 500,000 in ARR, but they can't seem to get above, or that million in ARR, but they can't seem to get above. The business has grown into the capability of that founder. Now, for the business to keep growing, the founder also has to grow with that business, meaning that the founder has to change who they are as the company grows. Think of it as, at first, you're hands on doing everything. Then it's you and your team. Now it's your team with you stepping back, kind of that guiding light, telling the team where to go. And then this team keeps getting bigger and you're stepping back even further. Now you're on a stage telling everyone where to go. So your role has to change as the company grows. And if it doesn't, that's where the company kind of ends up, right? It might get a little bit bigger, but eventually that's where the frustration comes in with a lot of founders, because they go, listen, I just don't know how to get to the next stage. It's like, okay, well, bring in the CEO coach, bring in the advisor, or maybe bring in some different executives, maybe even at that
A
point, you as the
CEO, yeah,
CEO,
of course. So stepping back into the word acquisition itself, and we hear so many different terms and types of acquisitions, whether it's a straight out acquisition, whether it's an acqui-hire or something else, and even for that matter, the structuring of the deal, the stock and cash, cash, all stock, and so on. While these are two different things that I'm talking about, let's pick one. What are those types of acquisitions that generally can be looked at?
Well, I mean, really quick, what you mentioned right there, the acqui-hire, which is just more or less this company says this engineering team has a skill set that we really want. Maybe they developed a product that's similar to something they want to develop. Maybe it's something that in-house they tried to and they couldn't, or maybe they really want to expand in a certain area, but this company has the talent, has the wisdom, the expertise, and they just go, you know what, it's better to buy this company than spend the next year trying to find engineers or whoever to do what we want without the guarantee that they're even capable of doing it as a team, whereas this group has kind of proven it. So that's kind of the acquire, and that's very common in Silicon Valley, or very common in tech. And we talked about financial, we've talked about strategic already. So, I mean, those are more or less the types of acquisitions that are going to happen. Now, how they're structured, that was what you're mentioning with the cash, earnout, seller's note, with rollover equity. There's so many components for these deals that people are not aware of. They think, oh, okay, I'll sell my business, I get cash, and then I leave. And it's like, no, 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 no. There's so many deal components that people need to be aware of. What does the transition period look like? What's your title in the new entity? What's your salary? Is it 3 years that you have to be there to get the earnout? Is it 4 years? Is it 1 year? What's the earnout tied to? Is it revenue? Is it EBITDA? Is it retention of customers? Is it based on the number of or percentage of employees that stick around past 1 year after the acquisition? Who knows? I mean, earnouts can be tied to anything. But let me go back even one step. So I mentioned kind of those components: the cash, seller's note, earnout, rollover equity. Think of it also as the percentage of uncertainty and the potential return, right? So cash, once that cash is in your bank account, that's your cash. It's low risk for you, high risk for the group acquiring you. Because once they give you the cash, you might say, bye, I'm out of here. I'm not going to follow through with anything else. Seller's note, okay, great. It's a bond. They have to pay you. If they default, you could take back whatever was sold. A little bit more risk, but there's still pretty good certainty. Earnout, what's that tied to? What are the parameters of it? Gosh, I remember there was a gentleman on my podcast. He was talking about when he sold his company, he missed a $10 million earnout. Why did he miss that? Well, it was based on revenue, and it was something like 12 million that, or something, maybe it was, no, it had to have been more, but it was based on revenue. And he didn't read the fine print that accounts receivable did not count towards that number. And him and his team were all excited because the end of the calendar year they hit that revenue target for sales that they thought that was needed. And then when they read the fine print, it said no, accounts receivable does not count, and it was all or nothing. So that earn out of 10 million, they got nothing of it. So earnouts riskier, but hopefully you're working with someone, a lawyer, investment banker, or whoever that can walk you through the fine print and the terms in the contract and help you position things so you don't have mistakes like that. And then you have equity. You're rolling it over into the entity. Maybe that becomes a huge win. Maybe the company that acquires you, their stock goes up 50%, 100%, or maybe it's an earlier stage company. 5 years later, they go public. It's a 10x. Who knows? Maybe that second bite of the apple in some situations is a lot bigger than that sale, but it could also go to zero, right? It may not be liquid. You may not be able to find a buyer for it. Maybe the company goes bankrupt. Who knows? And you'll hear, certainly if you studied the whole .com boom bust, the number of stories of people selling their companies for all equity that went to nothing, and one day was valued at whatever, half a billion dollars, and the next day they're working at Starbucks. The stories are there. So that could be the biggest win, but it's also the biggest risk. So how are you as the entrepreneur when you sell your company? How much cash do you want? How much of a seller's note, earn out, rollover, or equity in the new company? How do you want to do that? And then there's other things such as employment contracts, agreements, I mentioned before, your title, your salary, all those things. Now you're someone's employee, not a boss. That's a huge part of the transaction. Knowing it in advance before any letter of intent, before going out to market, saying, "Hey, this is how I want to structure the deal. This is ideal for me." And all those things I mentioned, there's different tax consequences, right? Talk to your wealth advisor, talk to your tax advisor, talk to those people because they'll tell you, listen, maybe you want this much cash and maybe you want this much of an earnout later on or a seller's note, or maybe it should be an asset sale or stock sale, or maybe it should be this or that. They all have a different impact. Or maybe it's even, whoa, your company, there's all these qualified small, QSB, these shares that you're at 3 years. Don't sell now, wait 2 more years and then you're not taxed. And they'll tell you all these things that people don't think about, that, maybe it's even just waiting another 4 months that you could save 40% of your taxes because of that. Or maybe you have that advisor that says, hey, move to another state now and then wait to sell your company. There's so many things out there that if you plan, you could take advantage of. Most founders don't know about. They'll contact me and go, is my company sellable? I'll say, it is. But it's just, will you get what you want for it? Will you be able to sell it and get the investors their capital back? Is there going to be anything left for you after the sale? Um, you know, this is what the landscape looks like. And sometimes they're shocked. I'll have founders say, "What we raised at a $10 million valuation." It's like, yeah, that was 5 years ago after you graduated, Y Combinator. You haven't been able to raise any capital since. You're a zombie company. Your technology's old. Half your team is already working on other projects, and it's obvious from their LinkedIn. Like, you're all checked out. Like, your company is really not sellable, or if it is, it's nowhere near anything that the past valuation was. Nowhere near that.
Many times, founders look up to their investors to guide them towards the right direction, particularly exits as well. And a large population of investors, as we know, are mostly emerging managers or the first time, second time managers who probably have not seen the any of those exits yet, right? Even in my fund two, I may not have made any exit from my fund one yet. I don't have an experience. What do you what few of those top 4 or 5 points you have both for the investors to keep their eyes on, as well as founders to keep their eyes on to stay ready for such kind of opportunities?
Well, one of the areas that people should pick their investors are their relationships. Are these investors, do they have relationships with the potential strategics, the potential financial buyers, all these different parties? I mean, they should be thinking about the next round or the exit. So hopefully already the investors are coming to you with those introductions or those conversations and saying, okay, this is what I talked to with this person at the golf course or wherever, pickleball court nowadays. That seems to be where a lot of deals get done. And, you know, if we hit these milestones, I think we can get this type of valuation bump. And let's kind of plan this out what the next year looks like. Because remember, these are long-term transactions.
Yes.
Um, but also at the same time, they should be saying, you know what? It's kind of time for us to have an initial conversation with an M&A attorney. Let's have you, do you have a wealth advisor or tax strategist to talk to, kind of see what an exit would look like with your financial future, and would you be happy? And they should also be guiding you to kind of build out this team. Hey, let's get that investment banker in this picture to kind of tell us what he's seen in the market or she's seen in the market and what multiples are, or if he's had any conversations where strategics have reached out to him and say, hey, we're looking to move in this direction next year, or we're doubling down in this. Let us know if you have any deal flow. Um, they should be constantly kind of asking you what services or that do you need to move this company forward in the growth, and also, you know, looking over your financials every board meeting, looking over, the growth of the company, look at all those things and kind of pointing out to help you get to the next stage. Because, as this companies grow, it's more valuable for everyone involved. And then also to let you know, hey, from our experience, you might start reaching this peak here. We should start looking for new CTO or new this or new that position in the company as it's getting to these things, or here are things to watch out for. I mean, all those warnings, advice, it's really to keep the company going to the next stages. And each stage you go, there's different groups that are going to be interested in acquiring. Different groups look different. Different groups interested in investing. Different possibilities for that exit, even.
Another thing that comes to my mind is around the CVCs being part of your investor mix. So
Mm,
what is your thought on that, and what is the right timing to have these CVCs? Because I see some or hear some contrary views on involvement of CVCs early on versus later on. There are views which says that having a CVC in your early round kind of have an impact on your valuation growth if there's a serious acquisition thought from them, and have them later. And sometimes it's different. So, what are your thoughts
yeah,
about it? When do you have them? Should you have them at all, and so on?
yeah. So corporate venture. So it's that's a tough one because I'll meet founders that go, "Wow, this one company approached us and they're looking to invest, but we know if they do, they want all these clauses of information saying that, this and that, this and that. We know that they're competitors. We're not really going to be able to work with them, or it's going to be awkward, or we're not going to be able to get acquired, or all these things." But then you're also going, wait, didn't you just tell me yesterday you have 2 months of runway left and you're going to close down if you don't take money? So, oh, yeah, well, say, okay, well, where's the balance? And this goes to the advisors, the mentors, whoever's working with the company right there to really assess the whole situation with that company. And I say that the whole situation because, I mean, right there, if you only have a few months of runway, you don't have the same options really as that company that's going, we don't need any money, but we want the connections or the distribution that this investor can bring to us. Or, they have a couple of experts and we're going to get this member to work with us because of this investment. Or um, by having this partnership, we're going to be able to, I don't know, adjust this, change the software and everything else that we're using, so we're the ideal acquisition target for this company or maybe one of their competitors. But we're going to get all this inside knowledge because of this investment, this partnership, and this. There's so many things that you only know if you're in the conversation.
Yeah.
And that's what I would say to people. Don't close any door until you actually peek in the room and see what's there. It could be the greatest thing ever. I've met many companies that their investor from that corporate VC made their company, put them on the right path. They got acquired a year and a half, 2 years later by the company. I mean, even like the founder retired after the acquisition. Like, I've met people over the years where it was the most incredible decision and their life would have been completely altered if they hadn't made it. Now I've also met the exact opposite, where they took the money and then they were handcuffed and weren't able to do anything, and they said, that was the biggest mistake of my life.
I think that brings a lot of clarity, at least from the fundamental point of view, which I wish to cover in this conversations. And any other parting comments that you have for our listeners?
Yeah, one, any type of acquisition that comes, talk to your family, the people immediately close to you, because their lives are going to be impacted by it. And what I mean by that is these transactions, I mean, they're 6 to 9 month transactions from beginning to end. And I'm not sure if you have a minute. I mean, maybe we could even talk about what happens in one of these transactions. But okay, I got the nod, so okay, I'll go on. So these transactions start off with, you're building out the data room, the market material, you're creating the investor list or the buyers list. You're going out to market, having conversations where maybe you ask for an indication of interest. Then that turns into a letter of intent. Then you're going into due diligence for who knows, 60 days, 90 days. And in that due diligence, they're covering IT, legal, financial, HR, the list goes on and on. And then you're signing definitive documents at the end. But in this time, that 6 to 9 months or even longer, there's emotional roller coasters of ups and downs and ups and downs. Mental wellness during a transaction is huge. And I've seen it where people come to those management meetings and they're all upset because of an argument they had with a significant other, because they had to cancel a vacation because due diligence is going longer than they thought, and at home there's all these fights. And you warn people of, listen, this is the reality of what's going to happen. It's one of the biggest things you're going to do in your life.
Yeah, I
and,
hear you. I
and
think
they
that's an important one
yeah,
for sure.
and they just have to be right. The mental wellness of a transaction is huge there.
That's a very very important and very fair point brought in, and I'm glad that you brought that up. In fact, having said that, while you were calling out all the pieces of that life cycle of the transaction, perhaps we should take some time to have a separate conversation on the
Mm.
life cycle of the transaction as well, because I think this sets as a good tone as an introduction to the acquisitions. But then the life cycle of a transaction itself is a kind of a gray area for most founders and investors. I would love to have a chat with you on that someday as well.
Oh, I'm happy to dive deep, and we could go section by section, and I can tell you story after story of of things that happen at each of those segments in the transaction that you'll shake your head and laugh. And I think it would be great for your listeners. I think we could really help a lot of people.
I would love to do that, and thank you for accepting to do that. But yeah, for today, I really appreciate you taking time, Sean. Again, I believe this was a great conversation. I'm very hopeful that our listeners would have the same feeling when they listen to it, and we'll be very thankful for you taking time for this conversation today.
Rakesh, thank you for having me here. I look forward to continuing the conversation.